Here's the screen share and slides right there. It looks like we are still trading 59.18. So we had a retail sales number that didn't get us over the hump. It looks like the second case, sinking through the negative gamma range, actually looks like we might get stuck here. So yesterday, my focus was definitely on pinning 59.5. That was the largest strike in range, and even overnight during our call, it seemed like 59.5 was very much in play. So much so that even I discounted a little bit of the negative gamma beneath it. But of course, as time passes, if we don't get the bullish flow to persist, then decay means that those 59.5 calls fall off and become trivial delta. Not much of an influence. That said, that seems to be what's happened. We found a little bit of some implied support around 5900. The range looks to be 59.06 half to 943 quarter. And right now, again, we're trading around 59.20. It looks like we might be in a neutral zone, kind of, with the only caveat being that the distribution of inventory between market maker and firm is large on some strikes. So some expirations, we get mostly just market makers holding inventory. Looks like market maker and firm hold divergent inventory on some big strikes, and we don't really know for sure how firms will hedge or if they've already hedged. So market makers, generally speaking, are shorter time frame hedgers. The firm trades, the firm inventory may be hedged on wider time frames. That could be into the open. We saw that in August, very clear footprint near the print. But at this point, this looks like it may be somewhat balanced, but we'll take a look in a sec. Yesterday's price action, 59.5 turned out to be very supportive. So one thing I'd point out a lot, and I mentioned in last night's call, is I focus on the AM inventory the entire week of Opex, not just the 0 day, but also the AM. So I must look forward to the depth view positioning in order to see what the strikes are on balance, because it seems to me like their magnitude is almost amplified. I don't have a great way of quantifying that or even validating why exactly that would be the case, but it seems to be the case more often than not. What's interesting here today is we already have November nearly expired. And so you see the, in my opinion at least, the position was pretty much influential yesterday, where the charm that would have been implied with the AM position seemed to be present to a greater extent than was visible on the 0 day profile. The gamma of it seemed to be supportive as well. So there's some negative gamma below 59.5. There was some reason for us to have a charm sell off into the close as well yesterday, just based on 0 day alone, because a lot of the 59.5 puts that were held short by customers yesterday were closed, leaving only the 59.40 puts as the largest dealer strike in the 0 day. But we found stability no matter what. We did wind up printing right around 59.5. So to me, that's clear indication that the AM position is stronger than is indicated. But again, I'm not going to speculate on exactly why that might be. This is tonight's range. So I put a screenshot in the chat as well with a little bit of an update post 8:30. Right now, again, it looks more suppressive than anything. We keep kind of grinding sideways lower. Right now, we're implied 59.18. You'll see that the implication today is not necessarily for a bullish impulse. So if you look at this gamma profile, what you'll come to notice over time is that when you see strong zones of positive gamma contribution, what you're going to notice is that these are associated with suppressive charm flows. So it's two sides of the coin. These positions interact with flows in a way that's either suppressive or supportive to some degree, right? Meaning that if there's a concentration of gamma below the money, that will be supportive because the gamma that dealers have to hedge will grow as spot sells off. So in a sell-off, it becomes increasingly stabilizing. That produces the contained ranges we talk about. It's the opposite of accelerant flows, but it also really does set some boundaries or floors, with the opposite happening on the upside. When you start running into ranges where a lot of local gamma exists because of strike concentration, the amount of dealer gamma hedging slows the rally and contains volatility locally, but that feature also tends to create resistance. So this creates ranges, or at least expectations of ranges. The flip side is once we're in the territory of the local concentration, the gamma, the way the position is supported, for example, depends on the interaction with other flows. It absorbs selling flows. Now, the flip side of this coin is that if time passes and nobody's trading, no buyers come in to move the needle higher, the flip side of this coin is that those selling flows that are absorbed, they're then sold back out passively on an accelerating basis into the close because of decay. These options are not permanent features, they're short-lived. So in some sense, that's why I call it slowing and trapping, because it stabilizes and supports the price action, but then it acts as an undertaker to the downside or like a levitation on the upside because of the buyback of decaying option delta. That said, you'll see what today's charm profile looks like. This is the charm profile expiring the AM position. So this is only PM and beyond. This is after 9:30 mostly. This is not very supportive. So yes, even though if we skip forward one slide here, and look at this inventory, these positions here are supportive. They do produce buying flows during the day if price sells off. But if price sells off and the options, hedgers, are the ones taking the other side of the flows, and no one else comes in as a natural buyer to turn the tape, the delta decay means that market makers are selling back out those futures into the end of the day. So that actually produces today a pretty strong charm profile. I don't have it listed here. I should have done that. But if you look at the options depth profile and hover over the map, for example, at on the open at 9:30, if we don't move, the initial charm value of 11.33 at 59.20 implies that every 5 minutes, dealers are selling out 22.66 futures. It's not huge, but it creates a passive signal and an imbalance in the flow. Now, that number is pretty stable in the first hour, let's say. By the time we get to noon, if we drop any more, let's say we're trading let's say coming into the day, we also have XYLD to look forward to, the Global X ETF buy right in the SP. They start selling their at the money calls at 11:30. So that's a lot of delta for sale too. If we come into 11:30 trading 59.10, the charm flows alone, this has nothing to do with the Global X ETF flows, but the charm flows alone imply a passive sale of around 45 minis per 5 minutes. That's pretty heavy. Or take that with a grain of salt. The other side of that is we'll expect over the period between 11:30 and 1:30, roughly another 6,000 minis for sale via these at the money calls. Now, charm continues to grow. So the interesting thing is these values from the get-go are larger than most days have on their profile. And let's say we're trading 5,900 at 2 o'clock. If you're expecting a bounce after this order completes at 1:30, well, at 5,900, the value on the profile is 30. That implies a passive sale of 60 minis per 5 minutes. So this is a very suppressive day. This is not the free money Friday that people get used to on Opex. This is not an instant rally type of day because of expiration. This is actually a very heavy PM expiration because of the concentration of inventory here. It's all this. Everything here, especially if we break 5,900, is trapping. This is all long gamma. It would be a very stable sell-off, a very tight range sell-off, but the amount of selling flows associated with it, and of course the floor around 58.80, meaning that the gamma flows, if we break this, become very severe and very stabilizing. This is a very, very, at least prescriptive path for a down day after expiration, unless we somehow come in and open, let's say above 59.30. If you look back, if we do somehow open in this range, we have a different path implied, right? But as long as we're here, this is 20 or so minis for sale, and it just keeps growing. By the time you get here, this is minus 60 for sale every 5 minutes. And of course, the end result would be the dealer's largest strike. So forgive the nonsense on the highlighter here, but that would be the prescription from charm. Pretty heavy day, at least implied. So whatever the news is, whatever the narrative is, just know that the expectation in this range is not for an obvious bounce. And my expectation too is that where we are now, we're going to start to see a different tone out of the VIX, because we're going to start to come into a range where, on balance, the calls to the upside will have less Vanna, but the puts to the downside will have more Vanna. That's what I mean when I talk about this fulcrum effect, where the nature of the position is like a fly. And the VIX should not be below 14 today is my expectation. So that's kind of all I got for now. The takeaway last night, I'm going to go through a little bit of the inventory yesterday with you right now. If you guys were on the Opex call, the preview, when we were looking at the inventory, We were already sold off a little bit. I think the low was around 59.28 or 59.28.5, something like that. The implication here, if you look at these different positions, these are different constructions of the same thing. This is all November AM SPX inventory broken down by entity type. Now, again, this is part art, part science. To the extent there's convergence and that this dominates the flows, it becomes much more science than art. But for example, I've not been that excited to trade these profiles since the election, only because of the expectation of pent up either supply or demand, really just a pent up need to trade external to these options profiles. Sometimes they work very, very well, but in my opinion, the best time to use them or to really size your bets up is when they are kind of either large positions or modestly sized positions against a very thin and disinterested tape. That said, going into the holiday period, once we kind of find a balance here, and maybe after next week into Thanksgiving, we probably will see some very influential profiles because of the implication that flows dry up. But it seems like, at least since the election through today, strictly speaking, there's a lot going on. We've had some pretty heavy MOCs. Just doesn't feel like it's the right time to bet more on these. But that's my opinion. Make what you want of it. But back to just the construction here. You have market makers, you have firms and broker dealers. And generally speaking, the firm inventory is expected to be hedged to some degree. It's not always the case, and there's some different opinions on this. Even when the banks articulate why they do this, they're not exactly clear, admittedly, on why or why not they'd include one entity type versus another. Or they're also not firm, no pun intended, on how much of this inventory is hedged. So it makes it a little bit difficult. Yet we're still sinking. It's trading 59.16 implied. So with 20 minutes, just keep in mind that all of the delta associated with the options, I'm going to use this one here. All of the delta associated with these 10,000 59.5 puts, even really these 59.45 puts, 59.40 puts, all of these are probably so deep in the money that they have really no delta left. Remember, this is now a 20-minute straddle, so you can write these off. What seems to be influencing us now is this local charm influence. And this, I alluded to this yesterday at the end of the call. It was not my base case because at the time of the call, it seemed like we had a good chance to recoup this. We sunk through 30 and retraced a little bit. I think by the time the call was over, we were trading 34 or 35. To me, that was reflective of a high potential to recoup the sell-off and land on 59.5. Obviously, the big elephant in the room is 59.5 strike. However, you can see here that once we break through this and time passes, we've shifted two dimensions now, time and spot level. Even though these are smaller numbers, these begin to be more influential. It just is what it is. So when you look at this now, we have 59.25 strike. Dealers are short. That is negative gamma, but it's also suppressive charm. And then we have everything between 5900 and 59.15 is somewhat stabilizing because it is positive gamma, but all of this implies some delta for sale. So 59.15 should be somewhat of a floor here, or sorry, no, that's 59.10. 59.10 should act like somewhat of a floor, and the additional delta to decay away and compel selling would probably, at least just strictly speaking, if this is the only flow happening, force a pin right around 59.10 or just below. But the other side of this too is we do have probably some amount of straddles decaying or being sold based on this PM inventory that we just looked at. If this were my desk and I was looking at this position, this would suck without sugarcoating it. This position sucks. You're sliding into intensely terrible decay and pretty unfavorable gamma decay or gamma theta because of the distribution of options below the money. You're sliding into higher vols and long local skew on a 0-day profile that really just is kind of brutal. Produces a lot of delta for sale, and it's not something that you want to hold. Your best case as a market maker right now is a strong bounce. You want someone to come in and save your life here by buying futures and putting in a stop to this pain. Because as we're drifting lower, all that's happening is you are losing money on your existing position, on the hedge associated with these options, and on this. And then dynamically, what you're actually seeing is you have every refresh, you're seeing long delta, and you're seeing you've lost money on theta, and it keeps happening, unless you actually get really high localized realized vol or a bounce away from it. If you bounce away from it, that's great because the options run to zero pretty quickly and you can scalp your gamma, but it's what's going on right now is not fun. But we don't care. It doesn't matter for us. But yeah, the interesting thing, the only wild card here I kind of alluded to before is that you can see for the most part that there's some alignment here all over the place. Market makers and firms both hold the same inventory on 59.5, directionally speaking. It's the opposite of the customer book. However, when you get down to 5,900, and sometimes you see this, especially, I don't have all of the inventory here, but if you were to look even farther down the chain, I've found in the past that it's often the case that firms need downside protection into expiration, whereas market makers have more of a random distribution of inventories. Now, I'm saying that kind of anecdotally and off the top of my head. If somebody wants to fact check and go through it and say, actually, no, that's not the case, that's fine. But sometimes you see these expirations where there's almost like ascending quantities on the put units because for whatever reason, firms need additional protection against whatever they might hold. This used to be almost an implied feature on Thursday afternoon where we all just knew going into the close that there'd be some kind of chase where all of a sudden the base case was, okay, how are the 5,900 puts? Pay whatever you need to get 5,000. The next thing, how are the 58 puts if you still need it? They might be worth nothing really. This is a tomorrow put, but you see prices sometimes that make no sense, but for whatever reason, they're just needed. And so on the downside puts, sometimes you do get divergent positions. We have that today. The only thing that's interesting about this to me is if we do somehow break to 5,900, the nature of the delta hedging is probably a little bit different. I wouldn't know for sure whether to expect this to be hedged. This would obviously be hedged, but this would be hedged on some smaller time frame, like it would be actively hedged now and into the open. But this would stand to be discretely hedged, where like if we fall through it, we get a sharp V rebound as these guys step in and hedge the strike like a straddle. So not sure what we'll see. About 15 minutes. I'm going to switch over to Bloomberg just for the sake of showing the live market. And I'll just leave it running until the open. What you're going to see then is obviously this screenshot that I put here. The implication, again, this is just literally futures minus BTIC. It's not a complicated thing, but it is a good way to observe the flow. Probably it would make sense here to use the taco, but I'm not going to reinvent the wheel this time. It does look like the base case it's definitely not a rally back to 59.5. That's for sure. For the sake of granularity, I'm going to just switch this a little bit to show just this 30-minute window. The reason I watch it this way is because there is no SPX market right now, obviously. Oh, PvP are killing me. Could be better. Let's see. Stream quality. Source. Well, I won't be talking, so if it messes up the audio, that's not a problem. And oh, did we lose it? Is 60 frames per second way too many? Can you guys still see the screen share or no? Oh, you can. Great. Okay. Well, I can't even see my own screen share, so that's great. Great equipment. Yeah, look at this. You can see the local influence really kind of take hold. So now it's combined influence. It would take somewhat of a really contraindicated step in here to change the direction. Positioning is what it is. By the time we got through midnight and in the early morning, and we didn't recover 59.40, I think the 59.5 pin really started to fade. I should have been more explicit about that in the meeting last night too. I was probably a little bit overly focused on the retrace and settle on 59.5. So in the future, I think when I do these, I will create paths so it's more clear what kind of conditions presuppose certain outcomes. This to me is kind of obvious, but of course it's because there are a couple of distributions. You can either get back over that hump that we talked about last night, get through the negative gamma in the high 30s and low 40s, and stick to 59.5. That's one path. If that doesn't hold, I think at the end of the call, I mentioned that we'd probably get subjected to this dynamic here in between 5,900 and 59.25. Much smaller force, but the fact is, once we move away from the other strikes and you take time out of that straddle, those influences are gone. So now, by the time we get here, even though those positions between 5,900, 05, 10, etc., and the quarter 30 call spread that dealers are short, even though these are much smaller than the 59.5 inventory, it still does take over. So it is what it is. The other side of this too is I can't possibly overstate the importance of the PM charm. It's very, very large. Mikey P, you're already ahead of us, dude. For PM, if we don't get a bounce above 58.30, you're a handle off at 9.30. I can see where your mind is going. But yeah, that's correct. That big concentration on the 58.80 puts, that is surrounded by other longs too, but that's the stuff that's going to kind of force us lower. It's very basic. It's just a bunch of put delta. Market makers are long a bunch of puts that are out of the money. They're long futures against it. And as time passes, we know this option expires today. It doesn't really matter what happens with volatility. This option has a ticking clock. And by the end of the day, all that delta has to be adjusted. It happens in real time. Market makers aren't going to carry a bunch of naked options or naked delta against positions that are large. It's too much variance. It doesn't make any sense. Unless that's your agenda, unless that's your value add or your bread and butter, I guess, for lack of a better term, which I don't think is the case these days. Another thing that's kind of just anecdotal is, in my experience, I left the industry early this year, technically, but pretty much last year. And over the last several years, really since COVID, it was increasingly difficult to carry positions of any size. So it's not just a function of desire, it's also a function of cost. Even if you think you have edge, you also have to account for cost. And if the clearing firms charge you more money to hold certain positions, and they systematically ratchet up these costs over time as positions in general keep growing, they want an efficient clearing process. They don't want firms holding imbalanced inventory. So everything kind of just goes to reinforce this idea that these positions are hedged. It's not some maybe. I think there's a lot of respected people out there that still believe that this is up for grabs, or it's up in the air how and when or what positions are hedged, but it's very much a requirement of doing business. Next time we do a screen share and we just watch this screen, the ticking futures, I'll make sure to have some music in the background. My wife has good music on in the background, and I feel sad for you guys that you don't have it too. Yeah, just the quiet tension of where will this go. This is actually what it feels like for a market maker. You're just watching in anxiety. I don't even have any money on this necessarily on today's settlement, especially not in this range. But even me, I still have like this memory of like just not liking the outcome. Screen share with comments for the whole day. That'd be intense. Maybe I'll do that some days. It's not a bad idea. Look at this. Oh yeah. Oh good lord. Aggressive charm flow. Last 5 minutes. This is fun. If I could just see us on the desk right now, like face palming, you're like, of course this is going to happen. Sink right into our long. Well, the bull thesis may still hold. Remember, these inventories change, so we'll see what happens. Maybe today midday, I'll walk you guys in the VIP mentorship through the option depth view post Opex. We talk about unclench. Unclench can go either way. This comment, you mentioned that funds would want to step in and defend 5,900. I don't know that funds would want to or not do that. I'm kind of saying that it would. How should I phrase this? We're getting a little bounce here. What I was kind of alluding to or trying to make clear is that the interesting thing about the inventory is that market makers and dealers, market makers and firms, banks, for example, that have big positions, are in some ways offsetting each other around 5,900. And so what I was kind of trying to suggest is that there's some implication here for volatility or really an unknown outcome around 5,900. The reason is, on balance, if you go back to the position, it looks pretty much, it's modest. It's like, I think, well, now I don't have the slides in front of me, but it's not large. Let's see. At least the way I looked at it, the market maker plus firm, it was only about 700. But what that number hides is that two entities which may be hedging, firms and market makers. One of them hedges very continuously, one hedges fairly discreetly. Firms are long, just over 5,000, whereas market makers are short, around 4,400. So the understanding that the position is held, there's kind of a squaring off against two types of entities with different hedge profiles, but that are likely to hedge. It's like when I talk about the tip of the iceberg, right? If you look at 0-day positions any given day, you don't see necessarily the breakdown of who holds what all the time, and most of the time it's trivial. But around an expiring position with this line, it's kind of interesting. Because market makers should be hedging somewhat continuously. Firms may be hedging more discreetly, but firms also don't really have an incentive to buy futures unless we're through the strike. And we're not. Or if they want to straddle it, and it doesn't seem like that would make sense to me yet. Let's see. The 905 puts, the 910s, there's small divergences there, but nothing like 5,000. That's a big number. All right, final 20 seconds coming up. Looks like it's still respecting the 5910 implication. Brutal. Oof. It's interesting. HMB says for what it's worth, TIA's gamma or tier 1 alpha, tier 1 alpha's gamma flip level is 5910. Yeah, I wonder what the process is. I've talked to Craig a bunch of times, and probably we should connect and speak a little bit. But that is interesting. So what happens now is the SOQ, every individual equity component opens up and finishes their auction process. Those numbers are then reported, and we get this print trickling in. The settlement trickles in. So it's not instantaneous, even though, for example, whatever the open was. Hold on a sec here. Does anybody have the opening value of the SPX handy? Just to track how it diverges from the SOQ, maybe. Cool, thank you. So yeah, it'll be interesting to see if the SOQ comes in above or below this number. We looked yesterday, the chart I put up there during the slides last night had the distribution of outcomes. It's usually clusters around 0. Seems like it's been to some degree trending a little bit lower, but it should cluster around 0. There shouldn't be big divergences. It looks like the SPX is staging a little bit of a bounce here, which in some ways makes a lot of sense. If you go back to the options depth profile, see here. Let me switch my screen share now. Hold on one second. Okay, morning meeting. Here we go. Okay, sorry. What's interesting is we should probably expect bounces on opens like this, even though charm is suppressive. To some degree, you'd have some pent up gamma hedging. At least that's my base case most days. Opex really kind of throws a wrench in things because you're really hyper focused on gamma hedging overnight, even if it's not your usual way to do things. So it might be a little bit different today, but what I want to make very clear is that if you're playing for a bounce because it's Opex or because it's Friday, which I've actually seen people do, there's maybe stats around Friday rallies or whatever, just know there's some real flows to contend with. There is the suppressive charm that we talked about, which is very real and pretty serious. It's not, these numbers are not small. If you're used to looking at these profiles, you'll know what I mean. It's rare that you see like 20 values of 20, or I guess to start the day it was like 11, but it quickly gets to around 20, then 30. Those are large values. And it's because, again, the positions are pretty large. So then not only do we have this, but remember at 10:59:59, Global X ETF, whoever manages that product or is tasked with execution, is going to look at the SPX. And if it's trading, for example, right now, 59:08:28, they would then say, okay, the benchmark, the nearest strike to the upside is 59:10. At 11:30, they start executing their program trade, and every maybe it's a couple of seconds, a couple of minutes, I don't know exactly what it is. It all happens electronically for the most part. It used to happen in the pit where different brokers would literally get these small par station orders and just announce the strike and sell it to whoever was first. Very easy trade to make markets on and take down. And everybody would fade it, it'd be good stuff. But now it's all electronic. So now it's like 25 lots, 30 lots, odd numbers usually, but always on the same strike, and it accumulates. So if you want to watch this flow, just take into account, and I'll make sure I put this in the chat at the time too. I'll be on the desk actually until around 1 o'clock. But just take into account whatever the strike is, use that heuristic, 10:59:59 ET, round the SPX up to the nearest 5 points, and then around 11:30, just monitor that strike in whatever tool you use. It can be as simple as Thinkorswim's time and sales. You'll see all the different prints happen over and over and over, and it will accumulate until there's around, I think, 6,000 or so to trade. I don't remember the exact number from last time, but their stuff is all public. So by Monday, they'll already have that stuff published on their website if you want to follow it too. Again, that's a live order. That's not sold tied up. Part of that trade, from the perspective of the position managers, they intend to sell delta and to sell volatility or to sell vega. It's a 1 month at the money call trade. and it's against a position of long equities. So all of what I'm trying to say here is you have not only the charm flows associated with this position, but you have passive selling flows coming from concentrated flows in the SPX today as well. So it's a little bit more of a bearish day, but midday I'll try to come back probably, let's say noon. I'll just set a time here to make it clear for you guys too. At noon, I'll come back to the desk and I'll walk through what the positions look like for Monday and beyond with the VIP mentorship crowd, so that we can at least kind of look ahead and have an educated guess about whether this should continue or whether a bounce might be in order. And to the point I made about the VIX, let's see where the VIX opened. Okay, cool. So yeah, 13s are off the table. It's not a huge drop here, but you can tell that the sensitivity to the spot vol correlation, the type of stuff we've talked about, having spot up, vol up, if we press above 6,000, that's gone now. Now we're kind of on the other side of this fulcrum. And in my opinion, the fulcrum's probably somewhere in the 59.5 to 6,000 range. And every time they sell more calls at 6,000, that raises it a little bit. But the point is that if you're a market maker, you're having morning meetings, what's most likely being talked about, you want to sell tight skew and buy wide skew. You don't want to own the 63 calls, you want to own the 62 calls. You don't want to own the 58 puts, you want to own the 55 puts. And this is all just to say that the position has been flied off around market makers' inventories, where locally the expectation is for not much to happen. Vol should be low into holiday period, should be low into year end. But just in case we crash or in case we rally, people want to be hedged. So what do? They continue to just pound the hell out of local Vega. They sell at the money calls or near upside calls. They sell puts. They sell put spreads. They sell put 1x2s. But they hedge it with things like the December 62 3-call spread and things like the December or D's quarterly 57 puts or 55 puts or January 57 puts. All these things go to produce the same type of profile where we were in what was looking like a neutral pocket of spot vol correlation around 6,000, where I even made a joke about how the VIX at 14 is just like kind of, okay, don't move. If we stay at 6,000, we're just going to grind a little bit lower until next week's settlement. But if you move off that line, market makers get exposed to short Vega pretty quickly on either side of the coin from their SPX positioning. And that then filters back into the VIX calculation, which is what we're already seeing here. You can see pretty clearly that, yeah, of course, we're going to come in with a gapped up VIX because we're down so much. But even after we had the regular market hours open, you can see that the tendency is not immediately for sale. This will take real flows to come back and sell vol to market makers to turn this around. Because as we go lower, the Vanna position that market makers will find themselves in becomes increasingly traditional and will be more speaking to spot down, vol up. So that's all I got for now. Thank you guys for hanging around. I'll be back around noon again to talk more about the post Opex positioning for the mentorship group, but also I'll put in some thoughts about the 0-day profile because a lot of inventory today, and whether or not it gets rolled or moved will be interesting. But certainly going into the afternoon, you should be aware of the stuff on the profile. Cool. Thank you guys and good luck trading.